Good morning, everyone. How's it going? I hope you had a beautiful weekend. It is 6 a.m., half an hour before the market is going to open on August 5th. Now, last night, when I was looking at the futures, it looked like they were taking a big dump. Looked like that there's some pretty big movement going on, and a little bit like there's some panic setting into this market. So let's take a look at that. I did look this morning. I do have an idea of what's going on, but I didn't do my full analysis. So we're going to do that together. There's going to be a lot of things that we discover together. So let's take a look at everything that is going on. So first of all, there was some news that happened over the weekend. One was that, well, not over the weekend, but on Thursday, Friday, Bank of Japan decided that they were going to start raising rates. That was this right here, this Thursday bar. And then we have this expectation in the US that we're going to start lowering rates. What that means is that the distance between the US rate and the Japanese rate has suddenly, in a very short period of time, the expectation between those two rates has suddenly collapsed. Before, Japan was at 0%, the US is about 5%, and there's a lot of people or a lot of institutions around the world that could arbitrage and say, okay, well, I'm going to borrow at 0% from Japan and then invest in the US at 5%. And that's almost a risk-free trade. So it's almost like free money, 5% for free. And suddenly that trade is at risk because Japan says, we're going to raise rates aggressively. We don't even have a target. And the US is like, well, actually, they didn't say that. The US didn't say that. But for whatever reason, the market is anticipating that the US is going to start cutting rates. I even saw an article this morning where they're saying, oh my gosh, because of this thing that's happening in the markets, we might have an emergency rate cut in the US. Well, if we get an emergency rate cut, I don't know. I may be out of a job because I keep saying things that are going against everyone else, but that would that would be such a blatant, obvious signal that the Fed is reacting to the stock market. And that's not their job. Their job is employment, inflation. That's it. So if they have an emergency rate cut because of what's going on right now, well, we got zero more data. They just had an announcement. They just had a press conference and they said it's going to be data driven. It's going to be a pool of data. It's not going to be a single point of data. And we need to see the trend. And then if suddenly, oh no, the stock market is dropping, oh, let's cut rates. Suddenly, all of that is out the window and they prove themselves to be liars. And everyone in the world blatantly sees that they're reacting to the stock market. So, in my opinion, anyone who says that we're going to have an emergency rate cut doesn't deserve to be in the business. They deserve to just be fired and they should go look for another job in another sector in another industry because that is just false information. And of course that happens, then maybe I should be out of a job. but uh they the point is that that's not the Fed's job. And do they sometimes react to the market? Sure. If they see panic setting in for a long period of time, like in COVID, then yes, there could be an emergency session. But this is not a COVID event. So they should not be intervening. So let's take a look at everything else. So what is going on and why there is this appears to be a huge drop in the market as we open up this morning. But I can just tell you that for us, it's a really good time. So if you had stayed with the recommendations that I've been giving, which is neutral, tail risk trade to the downside, like hedge if you're not neutral, like if your portfolio is way too big for you to go neutral, well, that it should never be too big for you to go neutral. But you had the inability to be in all cash and then with a tail risk trade, then what we were saying is that you'd be neutral with a hedge because I just didn't trust this market. And last Friday, the previous Friday, July 26th, I had a Q&A session, and one of the questions came up and said, do you think it's over? Do you think this thing that I was, because we did very well on a short over here, that was like over 1,000% in a short right here, and say, oh, do you think it is over, or do you think there's more to go? And my answer was, I'm wary right now, and so let's be neutral and have a tail risk trade or a hedge in place. And so on January 29th, or not January, July 29th, Monday, July 29th, we put in a tail risk trade on the S&P 500, which as of Friday, this little move right here, this gave us about 188%. Now with this huge gap down right here, I don't even know how to guess how much, maybe 800%, 700% gain right here. So that's two tail risk trades in a row that are firing off, which is possible in a downward moving environment, especially if there's panic. And there's definitely panic. If we look at our futures, let's take a look at our futures. S&P 500 down over 4%. It's 4.4 and a quarter, 4.3%. We've got the NASDAQ down 5.5%, and the Dow Jones down 3%. So that's definitely panic. That is not something that you normally see. Let's take a look at our VIX. Oh, okay. VIX is up at 57. I was saying that if we went over 19, then, and so we did go over 19 on Friday. And so that was a clear signal for us to I said, if we go over 19 and our S&P 500 or SPY was below 540, then chances are we're going down to the MA 200. Let's see how that is. Let's see how we're looking this morning, because we're definitely over 19. And I don't remember if we closed below 540. I think we did I think we maybe closed below the MA 50. Let's take a look. Oh yeah, we're definitely below the MA 50 and below 540. We closed out 532.9. So I said if those two events happened at the same time, then we're going down to the MA 200. And look where we're opening right here, 514.92. We're opening near the annual anchored VWAP. So it's possible that we find support here. So we could bounce off of here. We could chop sideways here, but chances are very good that we could continue and hit that MA 200. So are we panicking? No. The market might be panicking at this moment, but if I can see it, other institutional guys can see it. So they're licking their chops. They're like, ooh, look at this panic. Oh, people are going to be selling. When we open up this morning, people are going to be selling. They're going to be shaking in their boots and get me out, get me out, get me out. And institutions are going to have a field day. They're going to watch this drop and watch it drop and watch it drop. And either they're going to pick it up at that anchored VWAP here at this blue dotted line, or they're going to do it at the MA 200. I don't know if we'll hit the MA 200 today. It could be a couple of days of selling and then institutions swooping in and just candy, kids in a candy store. They're just going to pick it up, pick it up, pick it up. And I'm expecting at this moment in time, I'm expecting this MA 200 to hold, because panic does not last. Panic does not last. COVID was a slightly different story, because I don't know why I typed in COVID. I was just like, but because this was not a financial market. This didn't happen because of financial markets. This happened because of an outside event that was affecting financial markets. And so it did last for a few weeks. So this was the end of February to the middle or end of March. So about 1 month it lasted. But that's what happened over the weekend. What happened in this world? Nothing. Russians and Ukrainians are still at war. The Middle East conflict is still going on. The only thing that happened over the weekend was Buffett sold half of his shares of Apple. Is that a reason to panic? No. There's nothing crazy going on in the world. This is everything is as expected. And so this is a panic and an overreaction. It may last a couple of days. It may last just for today. If it's just for today, then institutions are going to pick it up at this blue VWAP, just like the previous pullback. They picked it up 1, 2, 3, 4 times at this blue anchored VWAP. That happened over here. Oh, sorry, that's the beginning of the year. So that we're our first pullback, it happened. Here we're having our second pullback or maybe correction, depending on how deep this goes. Then it may happen again at this level or at the MA 200. And again, if I can see it, other institution guys can see it, and they're not panicking. They're like me. They're excited. I don't know if you can tell, but I'm excited because this is going to create a lot of opportunity for us, and we're going to be able to take advantage of some really nice trades, just like we're getting 2 tail risk trades in a row, which is kind of crazy. Normally, there's a lot of space in between the tail risk trades. So they're going to be excited like I am, and they're not panicking at all. And we're not going to panic at all. We're just going to do everything we can to take advantage of this situation. So this futures, everything coming down, if we're saying this VIX cannot stay up here for long. And if we look back here, let's just do this in comparison to, look at that, COVID. So we hit 66 at some point overnight. That is almost as high as COVID. COVID hit 80s, but come on, we've never, and as far back as I can go on the VIX, we're above every single peak except over here, which is in the recession over here. We have more volatility than any other period except for 2008 and COVID. Come on. This one came close in 2015, but well, no, that's the current level. So we actually hit 65. So the only time we hit volatility like this was 2008, COVID, maybe 9/11 if I care to scroll all the way back that far. But come on, this is unsustainable. Even in COVID, it was unsustainable. Even in the financial crisis, it was unsustainable. And we're not nearly in that same situation. We cannot compare 2024 to COVID. We cannot compare 2024 to financial crisis. Things are not nearly that bad. It's just for whatever reason, people are suddenly afraid of a recession. Do we have signs of a recession? Yes. Are we going to get it tomorrow? No. Are we going to get it in 2024? Probably not. But we might get it in 2025. So this is too early. It's too early. Let's see when this type of volatility hit in 2008, September of 2008. When did this whole financial crisis thing start devolving? Oh, it was in September or November of 2007 was the beginning, but this is where like Lehman Brothers started collapsing, all of that. That was, excuse me, September of 2008. How do I know? Because I was working in the industry at the time and in CDS and CMBS, and I watched the whole thing. I had a front row view going down, and I know the day that my firm went to zero. I watched their ticker symbol go from over $100 down to zero, and then I watched everyone get laid off. Eventually, I asked to be laid off. That was September of 2008. Look at this spike right here. That is September, October, November of 2008. So when things are imminent and crashing down, that's when we get panics like this. And this is just an overreaction. overreaction. So a really great idea. Let's go take a look at a great idea, in my opinion, at least a great idea. Let's go long a put on VIX. Let's give it some time because, panic might take some time to resolve itself. Go 1 to 2 months out. October 18th. How much is a at the money put? $1,000. September 16th. Okay, 1,000. Okay, so they got really expensive. Obviously, the market makers are making this really expensive right now. So maybe you don't just buy straight out put. Maybe you buy a spread and just expect that this is going to come down. So that is, in my opinion, a great idea. Are we going to hit COVID levels? What is this? 2020? Yeah, 2020. Are we going to hit COVID levels of panic? No. No, this is nothing like COVID. So I would just put a nice little spread right here in order to take care of that situation, or take advantage of that situation. And in terms of the SPY, do you put on one right now? Risky, because we could bounce from this VWAP. So if you weren't already in place, like I said, hey, we're getting uncomfortable here. I'm getting weird vibes. And my read on the market is that there could be more to go. And so we put on a hedge right here on this day right here. And then so you had to already be in position to catch this, because now we go straight into support. And now it becomes a 50-50 trade. It's no longer a high percentage trade. And if we drop down to the MA 200. But if we gain, we fill the gap. So that gap is larger than the distance down to here to the MA 200. So now is not the time to buy a put in the SPY, because it'll whip around and slap you in the face. It may look good for a little bit because everyone's panic selling at the open, but maybe by the afternoon, institutions are starting to buy everything up and just whips around and you get hurt by that put. So in my opinion, it's a bad idea to start buying puts on the market this morning. What we should be doing, what now is the beautiful, beautiful opportunity is for your retirement account. And you want to start picking up shares of very long-term investment, 10-year plus investments that you want to hold on to. If you like Apple and you want to hold on to it for the next 10 years, go buy some shares of Apple. If you like Microsoft and you want to hold it, or Johnson & Johnson, PG, whatever it is, or those dividend stocks. Oh, the dividend yields are going to be nice and juicy this morning after a gap down like this. So now is the time to take care of that retirement account and not worry about swing trading or day trading or any of this stuff. Now it's time to look for those opportunities, because this type of thing doesn't happen that often. So that's probably where I'd be putting my focus on, is look for good opportunities to pick up, to re-enter or to load up once more, or add in another allocation of your favorite stocks that you want to hold for long periods of time, like decades, or pass down to your grandchildren, or whatever it is. Now is because this panic could easily over the next couple of days just pop right back up. Again, I am not expecting at this point in time, because of the way that we're coming down into the MA 200 or this VWAP, because it's a panic sell into it. I do not expect this to break. The chances of it breaking are like 10 to 20%. So we are expecting a bounce either from this VWAP or this MA 200. And then once I take care of my retirement account, now I'm going to go bargain hunting for swing trades. And I'm going to do it in the defensive sectors. We're not going to do it in SMH. We're not going to do it in NASDAQ. No. If you want to buy NASDAQ or SMH type of stocks, you buy shares in your retirement account and hold on to it for 10, 20, 30 years. If you want to buy options for a week or 2 weeks, then you're looking in the defensive sectors. Those are the ones that are going to be more resilient and going to bounce first. So let's What's a nice staple stock? Johnson and Johnson. Okay. Okay, you see that? All it did is undo at the pre-market what it did on Friday. That's it. It's not this panic gap down. What's another one? Procter and Gamble. Same thing. Not only half of the movement. Colgate, Colgate Palmolive. So not even, it went down 7 cents. It's going down 7 cents this morning. These are the types of stocks that you want to be in if you're going to swing trade right now. Let's see. Unilever, like the people who do like shaving creams and facial care, things like that. Oh, they're UL, I think. There you go. So yeah, it is gapping down, but gapping down where? To the EMA 8, not below the MA 200 or close to the MA 200 and the anchor VWAP, not way down here, way up here at the EMA 8, which is a beautiful place for it to potentially bounce. These are the types of stocks, potentially some healthcare stocks. J&J is kind of healthcare, but really the consumer staples, maybe some utilities. Let's look at XLU. Yeah, XLU is actually up. XLU's up this morning. XLP down just baby amount. XLV more, but still within the range right here. But if I look at XLK, like that, gap way down below the MA 200. XLK is already below its anchored VWAP. I look at SMH, gapping down below its MA 200. It's already below its anchored VWAP. These do not trade these under any circumstance. We had a rule last week that we would not trade these unless they bumped up above this 252 level. We are far from it. It is going to be a while before we're comfortable going into NASDAQ type of stocks. Right now is defensive sectors. That's where so let's take a look at gold. Gold is gapping down also, but not hugely, but it's gapping down. This is an indicator. If it was going up, then we would say that we're in inflation. The fear is inflation, but we're gapping down. That tells me that the fear is recession. So if I look at commodities, same thing, because technically gold is sort of a commodity. Yeah, gap down hard. Commodities being more expensive, rice, corn, wheat, pork, beef, those being more expensive would be inflationary. So the fact that it's gapping down is, hey, we're not afraid of inflation right now. We're afraid of recession. So don't buy into the panic. Recession is not today. It may be 6 months in our future, a year in our future, but it's not today. And this panic is today, and it's unfounded, and it's going to be institutions having a field day today. They're going to be picking things up. So in your long-term retirement portfolios, now is a great time to start picking things up. And in our shorter-term swing trading type style of trades, we're going to focus on those nice defensive sectors, XLP, XLU, XLV. Looks like XLP, XLU are doing better than XLV based on what we just looked at. So maybe just stick to those two sectors. And I would not be looking for new shorts right now. Like I said, that now is a potential bouncing point, or we could bounce off of the MA 200. Between those two, the chances of us breaking down below that MA 200, like I said, 10%, maybe 15 or 20%. But this is a lot of strong support right here. So the likelihood of it going down is limited. And like I said, the distance for us to go down versus the distance for us to go back up is in the favor of going back up. So your reward to risk ratios on puts and shorts right now is not there. So we need to look for the upside on the defensive sectors that have the potential that have to not lose that much, like, right? Or was it CL? What was it? PG? What was the one? Yeah, PG barely moved, and then I think it was XLU. So maybe some utility stocks where they're actually up in this panic. those are the ones that are going to preserve their value right now. And once those institutions kick in and start buying things up, they're going to be doing the exact same thing I'm doing. Staples, utilities, maybe healthcare, and this is going to start going up. Even though it already looks like it's parabolic, it doesn't matter. It can go up another 2, 3 days, 4 days. It doesn't a parabol. It's starting to go parabolic. It can do that for a few days. It can do that for a week. It doesn't have to come right down just because it looks like it's going parabolic. So this this is our game plan this week. I didn't even look at reports or at earnings because right now the market is in panic. They don't care about that stuff. They're just going to be selling everything. And it's going to be creating a lot of opportunity for us. So I'll just leave it there. I've been talking for a while. I think, yeah, we're only 3 minutes and something seconds away from the open, but do not panic. This is an exciting time. This is going to be really, really good for portfolios and for portfolio growth because now we can start bargain hunting on the right types of stocks and opportunities, and the potential for some big gains is there. Just like two tail risk trades in a row for us in the last week or so. That's not that doesn't happen very often. So there's a lot of opportunity right now. Get excited. We're going to do very well in this period. Okay, so we'll get ready for the open. Have a wonderful day. Don't panic. Just get excited. And I will see you in the aftermarket session.